You made a decent salary. You didn't splurge. You paid your bills like a responsible adult. So why are you back to zero? Again, most people assume this is a budgeting problem, a discipline problem, or a you need to make more money problem. But it's none of those. You feel broke even though you're doing everything right because the moment you start feeling financially comfortable, an invisible system wakes up and quietly absorbs every dollar you earn. This system has a name. It's called the middle class trap, and once you see how it works, you can't unsee it. My name is Max, and I make videos about the hidden financial traps keeping Americans stuck and how to escape them. If you've ever felt like you're working hard but not actually getting ahead, hit subscribe and give this video a thumbs up. It helps a ton. Because here's what's wild. 65% of middle-class Americans say they're struggling financially. Most people think the solution to financial stress is simple. Make more money, get the promotion, hit six figures, then everything will be easier. They believe there's a magic income number where you finally stop worrying about money. But here's what actually happens. You start your career making $45,000. Money is tight, but you manage. You get promoted to $65,000. For about 3 months, you feel amazing. Then you move to a slightly nicer apartment. You lease a newer car. You start eating out more because you've earned it. You upgrade your phone, your wardrobe, your gym membership. A year later, you're making $20,000 more than you were before. But your savings? Exactly the same, or less. This isn't a willpower problem. This isn't about needing a better budget app. This is a system, and the system has a name. Here's the real reason middle-class Americans feel trapped, no matter how much they earn. There's an economic system built around keeping you at zero. I call it the middle class consumption machine, and it operates on 3 core mechanisms. Part 1, the invisible lifestyle baseline. When you were making $40,000, a $25,000 car felt expensive. At $75,000, that same car feels reasonable. At $120,000, it feels cheap. Your sense of normal shifts with your income. Think about it like this. When you first graduated, sharing a 2-bedroom apartment with a roommate felt fine. Now, the thought of going back to that makes you uncomfortable. But here's what actually changed, not your needs. Your identity. You see yourself differently now. And that new self-image comes with a new price tag. Goldman Sachs calls this lifestyle creep, where luxuries become necessities. Once you've upgraded, going back feels like failure. Part 2, the social comparison engine. The second mechanism is what I call the social comparison engine. You're not just comparing yourself to who you were 5 years ago, you're comparing yourself to everyone at your income level. If you make $85,000 and everyone else making $85,000 has a nice apartment, takes vacations, and drives a decent car, you feel like you should too. There's an invisible range of acceptable consumption for every income bracket. Stay below it, and you feel like you're failing. Match it, and you stay broke. This is why 40% of people earning over $300,000 still live paycheck to paycheck. They're not buying more than they can afford. They're buying exactly what people at their level are supposed to buy. Part 3, the 5 cost anchors. But here's where the system really traps you. There are 5 costs that scale with your income faster than the income itself grows. Anchor 1, housing. When you made $50,000, you lived in a $1,100 apartment. At $75,000, you upgraded to $1,800. At $100,000, you're looking at $2,500. Notice what happened. The percentage of your income going to housing didn't drop, it stayed the same or increased. You're making more, but not any more financially flexible. And if you're trying to buy, the median home price is now over $420,000. At 7% mortgage rates, that's over $2,800 per month before insurance, taxes, or maintenance. Anchor 2, healthcare. The average annual premium for employer-sponsored family health coverage is now $24,000, with employees paying over $6,500 of that directly. And that's just the premium. High deductibles mean many families pay thousands more out of pocket before insurance covers anything. One emergency room visit can wipe out months of savings. Anchor 3, the childcare trap. If you have kids or plan to, this is where the math breaks completely. Childcare in major cities: $1,500 to $3,000 per month per child. That's up to $36,000 per year after taxes. For many two-income households, one person's entire paycheck goes to childcare. They're working full-time just to afford the ability to work. Anchor 4, transportation. The average new car payment is now over $700 per month. Add insurance, gas, and maintenance, and transportation easily hits $1,000 to $1,200 monthly. Over 6 years at 7% interest, that $35,000 car costs you $43,000. You're paying an extra $8,000 just for the privilege of paying slowly. Anchor 5, death by 1,000 subscriptions. The average household now spends $273 monthly on subscriptions: streaming, cloud storage, apps, online tools, Netflix, Hulu, Spotify, Amazon Prime, gym membership, cloud storage, premium apps, software tools. Individually, tiny. Collectively, over $3,200 per year on things you barely notice. The trap revealed. Here's what makes this a trap and not just life expenses. These 5 costs are designed to scale with your income. The more you make, the more expensive version of each one you're expected to consume. At $50,000, you have a modest apartment, older car, basic healthcare, no kids yet, and minimal subscriptions. At $100,000, you have a nicer place, newer car, family healthcare, childcare costs, and the full subscription suite. Your income doubled. Your savings rate, basically unchanged. That's the machine, and it keeps you exactly where it wants you, earning more, spending more, never getting ahead. But here's where everything I just said completely flips. There's a psychological threshold where your relationship with money fundamentally changes. Before you hit this point, your brain operates in what I call consumption mode. In consumption mode, you think, I need to make more money so I can afford the lifestyle I want. The entire framework is about income enabling consumption. You earn so you can spend. You want to earn more so you can spend more. After you cross the threshold, everything flips to what I call builder mode. In builder mode, you think, I need to build a financial system so money stops being something I worry about. The entire orientation shifts from consumption to construction. Money becomes a tool for building freedom, not funding lifestyle. The trigger point. For most people, this shift happens around a specific number, not in income in savings. Research suggests the threshold is usually somewhere between $10,000 and $25,000 in liquid savings. When you have $3,000 saved, you're still in survival mode. Every unexpected expense is a crisis. You're constantly calculating whether you can afford things. When you have $20,000 saved, something in your brain relaxes. You stop checking your bank account multiple times per day. You make decisions differently, not because you're rich, but because you've broken the paycheck to paycheck cycle for the first time in your adult life, the identity shift. But here's the deeper thing that happens. Before this point, you identify as someone who doesn't have money. Even if you're making $80,000 per year, you feel broke. After this point, you start identifying as someone who builds wealth, and that identity change affects every financial decision you make. Someone who doesn't have money sees a raise as permission to spend more. Someone who builds wealth sees a raise as a chance to accelerate their savings rate. Same raise, completely different result. The freedom calculation. Once you hit builder mode, you start thinking in terms of what I call your freedom number. Your freedom number is, how much do I need to never worry about money again? For some people, that's $1 million. For others, it's $3 million. For some, it's $500,000. But once you have that number, you can reverse engineer it. If I need $1.5 million and I'm currently at $20,000 and I can save $30,000 per year while investing at 8% returns, I'll hit my number in about 20 years. Suddenly, it's not abstract, it's a plan. And plans change how you behave. Let me show you what this looks like in real life. Before, consumption mode, Maya is 27, making $68,000 as a marketing manager. She lives in a nice one-bedroom apartment for $1,800 monthly. Leases a $35,000 car because she needs to look professional. Spends about $600 monthly eating out and on entertainment. Has subscriptions totaling $120 monthly. She has about $3,500 in savings. She contributes 3% to her 401k to get the company match. Her student loan balance is $28,000. 2 years later, Maya gets promoted. Her salary jumps to $78,000. Within 6 months, she moves to a $2,200 apartment, adds $200 more monthly to restaurants and shopping. Her savings, still $3,500. After builder mode. Fast forward, Maya is now 30 and makes $78,000. But something changed. After a financial scare, her car needed a $2,000 repair she couldn't afford without a credit card. She had a moment of clarity. She spent 3 months getting aggressive, stopped eating out, canceled subscriptions, saved every extra dollar. She hit $15,000 in savings, and something clicked. She stayed in her $1,800 apartment when the lease came up, bought a reliable $12,000 used car in cash. Cut subscriptions to only what she actually uses, $40 monthly instead of $120. A year later, she got another raise to $85,000. This time, her lifestyle costs stayed the same. She increased her 401k to 15%. The rest went to an index fund. 3 years after the shift, Maya has $45,000 in savings and investments, zero consumer debt, student loans down to $15,000, and a clear path to $500,000 by age 40. The difference, same person, same career trajectory, similar income. Before the shift, constantly stressed, no progress, felt broke. After the shift, calm, building wealth, feels in control. The difference wasn't the income, it was crossing the psychological threshold that changed her identity from consumer to builder. But here's where most people mess up, and it's critical you understand this. You finally hit $15,000 or $20,000 in savings, you feel that psychological shift, and then you immediately blow it on something expensive, a car, a vacation, a down payment on furniture, and suddenly you're right back in consumption mode. The anxiety returns, the progress evaporates. Don't do this until you understand the function of that money. That $15,000 to $25,000 isn't money you should spend. It's the foundation of your financial life. Think of it like this. You don't build the walls before you build the foundation. That money is the foundation. The correct sequence. Step 1. Build $15,000 to $25,000 in accessible savings. This is your I can breathe fund. Step 2. Stop. Let that number sit there. It stays there forever except for real emergencies. Step 3. Now start building your investment accounts on top of that foundation. The mistake is thinking that first $20,000 is a pot of money you can now use to buy things you've been wanting. It's not. It's the psychological bedrock that keeps you in builder mode instead of consumption mode. You can spend years climbing out of paycheck to paycheck living, and you can slide back in 6 months if you break this rule. Protect the foundation, then build on top of it. Once you understand the middle class trap, you start seeing money completely differently. You realize that the goal was never to out-earn the system. The goal is to step outside the system entirely. You stop asking, what can I afford? And start asking, what do I actually want my life to look like? Maybe you realize you don't care about a fancy car, but you do care about having 3 months off to travel every year. So you optimize for that instead of what your peers are buying. Maybe you realize you'd rather work part-time and live simply than climb the corporate ladder. Or maybe you realize you want to build a business and you're willing to live extremely lean for 5 years to make it happen. The point is, you get to choose. And choosing is only possible once you've broken free from the paycheck to paycheck trap. That's what the shift gives you, not luxury, choice. If this helped you see the middle class trap differently, hit subscribe, because most personal finance content tells you to budget, save more, and invest. That's fine, but it misses the deeper thing. The real shift isn't tactical, it's psychological. You don't need another savings hack. You need to cross the threshold from consumption mode to builder mode. Next video, I'm breaking down exactly how to hit that first $20,000 as fast as possible, even if you're living paycheck to paycheck right now. It's not about cutting out coffee. It's about understanding which costs actually matter and which ones are just the system programming you to spend. Drop a comment. Are you in consumption mode or builder mode right now? And what's your freedom number? I read every comment. Let's build wealth that actually gives you freedom, not just a bigger cage.